brings us to our final session of the day, and this session is on a topic very close to my heart. It's on Europe. For that, I'm going to introduce you to Robert Ward. Robert Ward, I'm sure many of you know, remember him from other visits he's made to Shanghai in the recent past. He's the country analysis director for us at the Economist Intelligence Unit. He has a long history of analysing various regions. He's a specialist in Asia. He spent quite a long time living in Japan. He has at various points been a bond analyst, studies various countries around Asia, now looks after the global economy for us. Particular focus on Europe, of course, in the last couple of years or so because of what's been going on there, and I'm sure you're going to find his remarks on what's happening in Europe, and particularly whether what's happening in Europe is creating an opportunity for Chinese firms, both interesting and entertaining.
Thanks very much, Robin. Thank you for raising my Japanese past. I first went to Japan when Japan was the future, which gives you an idea of just how long ago that was, and no one under 45 actually knows what I'm talking about when I say that, so obviously my forecasting skills were not that good when I went there. Just to give you a bit of light relief, I suppose, at the end of a long day, I can't think of a better way to end after a very content-rich long day than with a discussion of the Eurozone, the gift that keeps on giving. Just when you think it's over, it starts up again, as we're seeing now with Spain, and of course with Portugal as well. To set the tone, I just would like you to focus on this picture. This is a cover from one of the Economist magazines, and sometimes their covers are absolutely inspired, and I think this is one of the best they've ever done. It's a joke, I don't know whether you've got it already, a play on Apocalypse Now. Dead faces, it's been a long day. Well, if you don't get the joke, look at Angela Merkel's face. She's not someone that you really want to mess with, but of course the Greeks and the other weaker countries in the Eurozone have been doing just that. So just to sort of set the tone for you. A couple of takeaways from this. I am British, as you may have picked up from my accent, but I like the Euro. So whatever you hear, and fellow Europeans, keep calm. I have the best interests of the Euro at heart. So whatever you hear, it is with the sort of hope, in my view, that the Euro does succeed. This is our central forecast, by the way. We think about 70%, 80% chance that it will muddle through. That obviously leaves 20% or so that it won't. If it failed, very important point in this, if the Eurozone failed, it would usher in my view, a depression in the Eurozone. So not a recession, a depression. And of course, if that happened, given how big the Eurozone is, that would of course wash through into the United States, would wash through into China, and then would wash through, of course, into all the commodities producing countries like in Africa that Pat's just been talking about. So it would be very, very serious indeed. We have prepared an FAQ sheet on Eurozone failure for businesses, which you can get on our website for free, so do consult it if you are worried about it. Where's the clicker? Here, this one. Where are we in the Eurozone crisis at the moment? Well, I came across this very useful measure of crisis, how to sort of measure where you are, and it is, you may have come across it yourselves, the 5 stages of grief. So if you didn't get a promotion that you thought you should have got, you will probably experience all these emotions one after the other. And this is a very good way of describing how the Eurozone crisis is unfolding. In 2008, 2009, well, of course, we had subprime in the US, and all the Europeans were saying, well, those Anglo-Saxons, they're fiscal dipsomaniacs, they can't hold themselves back when it comes to debt. So, of course, we run our economies much better. But if you looked, and we were flagging Greece at the time, you would have seen that there were some definite serious problems in the Eurozone. Then after denial, you get anger. And of course, this is where we are slightly at the moment as well. You've got the North Europeans against the South Europeans. The North Europeans saying, well, South Europeans, you can't run your countries properly. And the South Europeans, of course, don't like being told what to do. I think this is where we are actually at the moment, and this is bargaining. And of course, this is Angela Merkel, this is Sarkozy saying, we know we've got to make difficult decisions, but please do not let the show go off the road while we are in charge. Let's just try and kick the can down the road and let's keep it going. But of course the problems here are so serious, you cannot bargain them away. But I think we're here, and why this is so good is because the next stage is depression. And we're near the end of the process, which is fantastic, because once you get to depression, you realise that there are sort of difficult things you have to do, and you're actually ready to take difficult decisions. And once you've got depression, you can then go to acceptance. The bad news, of course, is that you can experience all of these emotions at the same time, and you can also go backwards. So the sort of key message here, of course, is, as we're seeing at the moment with Spain, just because you think it's over and because things have got quieter, it doesn't mean that this is over. In the Eurozone, I would argue that the phase is moving from acute to chronic. And when that happens, of course, you're going to get continued blasts going forward, I would argue, over the next sort of 5 to 10 years, perhaps. If we think where we are as well, I really have to sort of show you this absolutely horrific chart, because it shows you just how much wealth and national riches has been destroyed since the Eurozone started to really go badly wrong a couple of years ago. I think I'm just going to pull Greece and Ireland up there as well. This is GDP per head compared with 2007, 2012. Look at China. This is why you're all in such good spirits. China really racing ahead, partly because of stimulus, of course, etc. But look at Greece. It's 20% smaller than it was in 2007, according to our forecast. This is, for Greece, catastrophic. I cannot stress to you how serious the economic situation is in Greece. Absolutely terrible. I would argue a depression in Greece. Look at Ireland, look at Portugal, look at Spain. All these weak countries really going backwards economically. By 2013, Greece will have been in recession for 6 years. We worry in the UK if we have 2 quarters of recession. Greece will have been in recession for 6 years. Portugal, by 2012, 3 years of contracting economy. Quite simply horrendous. And of course, this matters to you here in China because, of course, the EU, Eurozone, is your biggest trading partner still. So really very serious problems in the UK as well. Germany, of course, just nudging ahead, partly, of course, because it's so well plugged into the emerging markets, China, Russia, and Brazil in particular. So what's the problem? Well, of course, the core part of the problem here is the Eurozone was never a fiscal or a political union. It was just a monetary union, and even then incomplete. If you want a proper currency union, you have to have the following things: labour mobility, capital mobility, fiscal transfers and synchronous business cycles. And of course the Eurozone didn't have any of these. And why not, of course? Well, as we're seeing now, to have fiscal union, it's very, very difficult politically. It's very, very difficult to persuade taxpayers in Germany that they should pay for what's going on in Greece, and very difficult for the Greeks to accept that they should be told what to do in terms of their budget by others. And of course, key in my view to this is not enforcing the rules. The weaker countries, yes, they come in for a lot of flack because they didn't run their economies properly. But if you have the rules, we had the Growth and Stability Pact, it was not enforced properly. And there's only one thing worse, as it says there, than not having a rule, and it's having a rule and ignoring it. So this was not just a country-specific failure, it was a systematic failure as well. So pretty badly planned from the start. Any Germans in the audience? Someone nodding. I love Germany. I love the culture. I love the language, and it is a unique economy. And what I'm going to show you here, I can't imagine any other country, any other people being able to do this. So it's sort of a sort of praise for Germany in the sense of the way that Germany has reformed, fiscal reform, increasing competitiveness, and so on. What this chart shows you is the consumption of things over the last 10 years, normalised at Q1 2000. And what you see here, bear in mind, you had the biggest boom the planet has ever seen since it was created over the last 10 years. Everyone else was having a party, but the Germans were not. They were saving more, they were becoming very competitive, they were doing fiscal reform. And in 2007, in effect, what this chart is showing you is that there was no more consumption in Germany, after the boom than at the start of it. Quite incredible, very considerable discipline there. Let's look at the other countries now, and bear in mind the further these other countries' lines deviate from Germany, the sort of bigger their parties were, and the less, in effect, the less competitive they were becoming. Let's look at Spain. My goodness, that's sangria, that's siestas, that's a lot of sun, that's the good life. That's the construction boom that was actually bigger in many ways than that in the United States. 5 million new houses created, 2.5 million new households added to the economy. Of course, huge overhang in houses. Let's look at Greece, even more extreme. Greece is still unbelievably, given how serious its economy is still more expensive to go shopping in than Germany. Extraordinary. A loaf of bread in Greece costs €2. A loaf of bread in Germany costs €1.20. Germany's richer, yet it's cheaper. Greece is poorer, but it's more expensive, less competitive. Let's look at Ireland. Even bigger boom. Quite extraordinary. The one I feel sorry for is Portugal. Poor little Portugal. It's bankrupt, like Greece and Ireland, but it went bankrupt without having had the party. There was no party. Look at the others. At least they've gone bankrupt with having had a good time. Portugal, bust, but not having had a good time. Of course, Portugal did have a boom. Had a boom in the 1990s and hasn't grown since. So for Greece, this is a big sort of lesson. If Greece is lucky, it turns into Portugal. If Greece is unlucky, it continues to go backwards. So as you can see there, dieters, bingers, they all have to converge if the Eurozone really is to achieve any degree of stability, which of course means for Spain, Portugal, Ireland and Greece, further years of contraction. What needs to be done? Well, very easy really. You do need these things. You do need fiscal transfers. You do need fiscal consolidation. You need, most important though, you need economic growth. If you want to evaluate any of the policies that are coming out of Brussels or Berlin or Paris, very easy to evaluate if it's going to be successful. Will the policy allow the country to grow in the long term or in the medium term? If it won't, the policy won't work. So when you're looking at Greece, Portugal, Greece, it really has no prospect, in my view, of being able to grow the reach of the fist. Because I say to them, well, actually, you know, in effect, your welfare state will have to stretch from the Atlantic to the Mediterranean, because you will have to support this. If you don't, the euro simply cannot survive. And I do see some sort of positive signs here from Merkel in particular about expanding the bailout fund and so on. So politically the debate is moving forward in Germany, but it's a long way to go. And this is why we still assign about a 20 to 30% chance of collapse. And as I said, that would be very, very serious for the global economy indeed. And while we're on the politics, I have to show you this sort of wonderful picture again. Those of you who know your history will know that the Titanic sank about 100 years ago, a couple of days ago. And there's Sarkozy and Merkel in sort of embrace. I'm not sure they particularly like each other in real life, actually, but anyway, politically they have to be in the same bed, as it says there. What's going on in Europe politically is absolutely fascinating. You've got Merkel supporting Sarkozy. I don't know if there's any French people in the audience, but I cannot imagine that having support from a foreign leader, whoever it is going to be good for your election campaign. You've got Italy with Monti, you've got Greece with Papademos, sort of appointees of Brussels, if you like. So really important country, a founder member of the EU, of course, Italy, being run by a bureaucrat, quite extraordinary. You've got civil unrest in Spain, in Greece. You've got politics swinging to the left, of course, in France as well. So politically, Europe is going to be a very, very volatile place to do business in. Watch for protectionism. Look at the Schengen Agreement, so the agreement that allows visa-free border travel. That is not popular at the moment, so your sort of Europeans are pulling in the doors. So politically, going to be very difficult indeed. What are the scenarios? Well, our core scenario, of course, is that the Eurozone survives, and one of the key sort of positive things, if you like, over the last couple of months has been what the European Central Bank has been doing. It has printed money. It is QE via the back door. It hasn't solved the problems. The markets thought that it had. It solved the liquidity problem for the banks, but it hasn't solved the lack of capital that many European banks have. But it has stabilized things, and it has allowed the politicians, I suppose, some more time to sort out some solutions. There is, though, a sort of non-negligible 20 to 30% chance of collapse. And as I said at the beginning, I cannot emphasize this enough, it is very, very serious if this happened for the global economy. Nobody at all would escape unscathed by this, not even you here in China. With all your linkages to Asia and the US, this would be a sort of a world serious event. Leaving, however, is not a solution either. And this is why what makes it so sort of tragic if you, for some of the smaller countries like Greece and Portugal. One of the reasons that Greece and Portugal are so vulnerable is because if they left, and you argue, yes, the new drachma, the new escudo collapses, they could export their way to the sunny uplands of prosperity. Well, unfortunately, neither economy is open enough for this to really be a feasible thing to do at all. This shows you in billions of euros the sizes of the three economies, Greece, Portugal and Ireland, roughly similar, but only Ireland is a really open economy. Only Ireland has actually been doing quite well in terms of exports. The other two simply not open enough to really take advantage of having weak currency. If you think about Greece specifically, Greece doesn't export anything anyway of value, again, that really would allow it to take advantage, for example, of the Chinese growth boom or so on. Greece, you're thinking, what does it export? Olive oil, feta cheese, ouzo, yogurt. I don't hear yogurt anywhere. Yeah. Cement, actually, cement as well. Actually, Greece, and I found this out, you better watch when you buy Italian olive oil, because Greece exports 60% of its olive oil to Italy. So some of that olive oil you've been buying, thinking it was Italian, may actually be Greek. So do watch it, you heard it here first. So I say all these economies, they're just not strong enough to really take advantage of a weaker currency. So it's far better for them to be inside the euro and to be sort of skinning themselves alive fiscally than it is to actually be leaving. If they left, of course, you'd have bankruptcies in the state sector, in the private sector, you'd have capital controls probably introduced within Europe as well. You'd have banks going bankrupt, you'd have depositors losing lots of money as well. So very, very serious thing indeed, as I keep stressing, if the euro did collapse. Who's next? Well, after the ECB decided to print money, everyone thought, oh, well, it's all over. But of course then, the minute something starts going wrong, then it kicks off again. And now you're seeing, of course, with Spain and Portugal, even though there's so much liquidity in the system, interest rates there are still going up. And this is very, very worrying indeed. And this shows you the sort of full debt picture for the entire economy, so state and private. And what you see here, I must show you Ireland. It's got so much debt, I couldn't even fit it on the screen. And with Ireland, I mean, it's private sector debt, and the government's getting worse as well. Ireland's debt to GDP for the entire economy is about 600%. It is bankrupt several times over, unfortunately. But the one to worry about is Spain, because it is so huge. It's over $1 trillion economy. What you see in Spain is the public sector is not so indebted. The problem is in the private sector. Look at the green bar and the dark blue bar, particularly Spanish companies, construction companies, of course, particularly because of the Spanish construction boom. This is where the problem is, and because the economy is growing so slowly, and because they're doing pro-cyclical fiscal tightening, it's going to grow even more slowly. This, when you have a slow growth and high debt environment, this is phenomenally toxic for an economy. Look at Portugal as well. Their boom in the 1990s has left them with, again, a big overhang of private sector debt. So Spain and Portugal. Portugal we could probably sort of contain if something happened. Spain is the one to worry about because the existing bailout facilities simply are not big enough if push came to shove with Spain. If you look at Greece, the grey bar is the government. That is the biggest bit of it. The Greeks and the Italians, actually in the private sector, were relatively frugal. They didn't have a housing boom like we did in the UK or Spain. Neither did the Italians. So a very sort of differentiated picture, if you like, across the Eurozone. What does this mean for China? Well, as I said at the beginning, Chinese exports, EU is the biggest export market, Eurozone. Of the 200 countries that we forecast, I totted them all up, and the worst performing of the 200 that we cover, this is the bottom 10, so 200 to 191. You can see Sudan, of course, well, that's because it's been chopped in half, so it's lost its oil, I think. But look, you've got Greece, Portugal, Ireland, Finland, Italy, Netherlands, and France. These are the world's worst performing countries, in our view, in terms of growth, or lack of it here, in 2012. So for China, clearly, such a bad picture is not going to be good for your exports at all. We expect some growth to come back next year, but it's going to be pretty feeble. And into 2014 as well, just over 1%, I think 1.5%. So nothing really to write home about. If you're thinking about the impact, and we're talking a little bit about it in one of the breakout sessions, the impact of a sudden stop of lending from European banks into Asia. Well, some of the other countries are actually quite vulnerable to this because European banks are important in terms of lending to some of these Asian entities. But you can see China there really not exposed in terms of how much the Europeans are lending into China. And as we discussed at one of the breakout sessions, this is a great opportunity for Chinese banks to go into Asia to pick up the slack where the Europeans are cutting back their lending because they need to shrink their balance sheets. So China pretty sort of well positioned, if you like, financially. In terms of the risks and opportunities for China, well, this sort of really underlines the thing we've been talking about for the entire day. You're going to get a great opportunities as a Chinese company with nice, strong renminbi to get assets the like of which you never thought you'd be able to afford at really quite sort of bargain prices. I mean, the Chinese, one of the most interesting purchases for me of recent times by a Chinese company was that purchase into Thames Water, a British water utility, partly because, of course, the Chinese need water technology for their own water problems, but you're going to see lots of sort of proliferation of Chinese money going into lots of different sectors over the next few years. So there are lots of opportunities, lots of lending opportunities to get in there where the European banks are pulling back. But as I said, it says at the bottom point there, you have to be agile, because just when you think it's finished, you can have cycles within cycles, then it kicks off again. So you really do have to be watching, particularly the politics and also, of course, the economics. There is, of course, a sort of a reverse side to this, and that is protectionism, that is the politics. Very, very important because, of course, even though these countries are distressed, sometimes if you play the politics badly, even then picking up distressed assets is actually rather difficult. So there is opportunity, certainly, for Chinese companies within this sort of awful Eurozone picture. And this is the final slide which I'll leave you with, because what, of course, the Eurozone crisis has done has really accelerated the shift that Robin was talking about at the very beginning from the developed world to the emerging world. And this is another way of slicing that slide that Robin put up with the G7 and the E7. This is the world's top 12 economies, I think, compared in 2007 and 2020. And of course, it's not surprising. Of course, China's the largest economy. Of course it is. It's going to overtake the US in a couple of years. But it really is the Europeans sort of sink down, Germany sort of holding its own, UK as well. And of course, the one bright spot here for me as a British person is that in 2020, the UK is bigger than France. I like that. But of course, it's also an Asian decade. Look, China, India, Japan, ASEAN, Indonesia, Vietnam, Myanmar we're talking about, and of course you've got Brazil, and you've got Brazil for Latin America, and of course you've got Korea in there as well, which should never be underestimated for its ability to outperform. So crises accelerate existing trends, and the Eurozone crisis will certainly be firing away for the next 5 years plus, in my view. Well, thank you very much for listening to that, and I'm delighted to take any questions that you may have. Thank you. Any questions? Yes.
Again from the Ministry of Commerce. Thank you very much, Mr. Ward, for your excellent presentation. Just two short questions that I'm very interested in. One, you talked about the sentiment of protectionism in Europe. Could you elaborate a little bit more on that? Because we are quite concerned about what's going to happen, particularly because of the forthcoming general election in France and also the general election in Germany next year. So we are worried about the possible backslash in terms of protectionism. My second question is also very brief. What do you think of the kind of discussions about holding European sovereign debt, because there is some holding and there is possibly some more holding. So what do you think? Because in terms of foreign exchange holdings, definitely you need to diversify your holdings. You can't just borrow or invest in US treasuries forever. Thank you.
Well, with protectionism, as I said in my presentation, I think one of the key things to watch is the Schengen Agreement. Politically, it is not. There are no votes to be had in saying let's have border-free travel, because there's unemployment, there's people claiming benefits that shouldn't be, according to politicians, and so on. So look at that, see how that debate is going. I think a lot of countries are open to having money coming in and people buying the distressed assets. But as we were talking about at the very beginning, it has to be done with great sensitivity. I think the opportunity is definitely there, but the tide, if you like, the sense of openness, in my view, has diminished somewhat. You see it everywhere. You see it in difficulty getting work permits, even in the UK, which has traditionally been sort of very open. You see it in sort of discussion about foreign investors buying assets more broadly. But do look at the Schengen agreements. I think that's a very sort of good benchmark. In terms of buying euro-denominated debt, well, I mean, you have to make a call. Do you think the euro is going to be around in 10 years or not? If you do, then clearly you buy it. If you don't, then you avoid it, and you look in terms of differentiating between countries. You'd probably buy German debt, because even if the euro did collapse, the new mark would probably rise very strongly. But Germany is very competitive, so arguably yes, it would have a bit of a problem, but it could perhaps export, regain competitiveness quite quickly. I do have a problem with someone like Sarkozy coming to China and saying, please give us money, because we don't want to make the decisions, the difficult decisions that we have to fund this ourselves. We want to get other people to fund it for us, so we don't actually have to make the difficult decisions. And as a British person looking from outside, I do think that is actually a bit much. So I sort of advise the Chinese government to pick and choose which bonds they buy very carefully, because the situation is incredibly volatile indeed. Well, you're absolutely right. You do need to diversify out of treasuries, because we've been talking about the Eurozone, but the US fiscal position is also pretty bad as well.
Robin from International Paper. In the future trend of Eurozone, you have three scenarios. I saw 10% probability of Greece exists, but 20% for collapse of whole Eurozone. So could you please share with us the reason behind these numbers? Because more people think Greece exists, maybe have higher possibility.
Well, this is the sort of complete picture, and I suppose one of the ways of interpreting that is that 10% is Greece exits and it's okay, it's all contained, and then within the 20% maybe Greece exits, and that leads to contagion, and you've got Portugal, and then it goes to, as I said in the presentation, to France and so on. The key point, I think, Greece is in such a bad way, and as Robin made the point in the very beginning, to leave is not an economic decision; it's actually a political decision. Given all the unrest and so on in Greece at the moment, a politician may look at Athens burning and decide actually we do need to go. So the risk of leaving is quite considerable. I think it's certainly not our main scenario. The core point there is, does this then lead to contagion? So under the 10% scenario, it's contained, but under the larger scenario, it actually sort of the fires start burning in Portugal, the markets target Portugal, the markets then start to target Italy again, they bully Spain a bit more as well. So it's all about contagion.
This is Rick from Edenred, French company. A very hypothetical question. If euro collapse, what's going to happen? Can you visualize it step-by-step consequences? Thank you.
We could spend weeks talking about this, and we can have about 100 scenarios. It can happen in any way. I mean, really, there's no absolute sort of way that this would happen. You could. I mean, I suppose one of the difficulties of Greece leaving is how would it leave? Would it just leave overnight? Because if it announced it to when we're leaving in a month's time, then of course you get mass capital flight, people leaving with suitcases full of Greek euros to get out, and you actually already have a bit of capital flight in from Greece, by the way. If you're trying to sell a house in London, the likelihood is you'll have a Greek turning up with suitcases of money trying to buy it with cash. So a lot of money coming out of Greece. How would they do it? I think if you're thinking sort of a general scenario, you would have to have some form of capital controls imposed, because otherwise, the European banking system itself would be would collapse. If contagion spread to Italy, and that of course then hits the French and the German banks. Of course, we've got British banks that are exposed to Italy as well. So if you have capital controls, then of course you have the whole spirit of the EU. Of course, that's endangered too if you can't have the free movement of services and goods and what have you across borders. So how long would the capital controls last, and so on. You'd also have, of course, social unrest. You as a Greek depositor, you wake up and find your lovely hard German-backed euros and now nasty new worthless drachma. The Greek government has destroyed your wealth overnight. So of course you then go on the streets. So you're looking at a very considerable, intense disruption, which of course then would hit supply chains, would hit the ability to pay wages in some companies, get parts across borders and so on. So it is truly, I think, without exaggeration, it would be a sort of catastrophe for Greece. So what we're urging our clients to do, even though it's not our main scenario, is to brainstorm, just have an hour or 2 hours, how would your company cope with euro collapse? How exposed are you? Yes, gentleman in the blue shirt there.
Song Yong from Bio. In your interesting presentation, you said that euro crisis will go from acute to chronic, and you also, in your scenario, you mentioned that you give 70% of probability to this model-through scenario, and remaining 20 to 30 to Greece exit or euro breakdown. Does that mean that the EIU simply doesn't believe in any probability of United States of Europe, or is it because it's hard to forecast within your predefined time scale, I don't know, of the coming 5 years? And what does it really mean for the context of, what is the implication for the global corporate strategy for the multinational company who want really to compete and win in China, but who are also facing a rising state capitalism? Thank you.
I think with regards to the scenarios, what we're expecting is you get something like the ECB, the LTRO operations, so putting liquidity into the system, that then allows the politicians more time. You're going to get probably more bailout, another default in Greece, but that's expected by the market, so it's sort of contained. You get Spain, you need more capitalization for Spanish banks, so you get crisis after crisis, but it's sort of all contained, which is quite a heroic assumption, arguably, given what we've just been through. But then, at the same time as you have all that, you also have movement towards sort of more greater fiscal union. And the bailout packages, they are actually embryonic fiscal union, because I suppose ultimately it's the taxpayer that foots the bill for all of that. So we, I suppose, implicitly are assuming sort of fiscal convergence over the next sort of 10, 15 years, but sort of punctured with continued crises, but they get better at crisis management. And then they have the political debate in Germany and France and Italy sort of moves forward very slowly. It's sort of muddled through. So not a particularly encouraging one for those that want to see rapid growth in Europe. That said, Europe has still got, I think Robin made the point, I mean, at the beginning, it's still got some great companies, wealthy consumers, sophisticated management know-how, technology, very sort of interesting in terms of investment in there, in terms of trying to sell into Europe. They're going to be wealthy people there. There's a big middle class there, of course. So it's still going to be a sort of place that you want to be, I think. But you're going to have to be very nimble and sort of used to dealing with volatility, and you have your antennae attuned to the politics. So the lady at the very back there. I think that will have to be our last question.
Hi, as an economist, do you think David Cameron was right not to sign up to the fiscal compact in December?
No question on British politics. How awful. Well, he may be, if the whole thing collapsed, he may be seen as prescient. You know, why would I want to sign up to something that's going to collapse anyway? The issue for the UK, I suppose, is does this sort of greater fiscal union that I've been talking about then lead to a proper two-speed Europe where you have some big countries outside this fiscal union who then cannot make their views known because the sort of big mass of France and Italy and Germany are all singing from the same hymn sheet. So actually is the UK, by virtue of the sort of design of the Euro project, actually forced out of the EU as well? So I think that's probably the bigger question, and at the moment we just simply don't know because there's so many things left to be decided. Even though we had the fiscal compact in December last year, they all agreed to it, but it's, I mean, they've got to ratify it, put it through parliaments, and, you know, if Hollande wins the French election, he wants to renegotiate it. So nothing's a done deal at the moment. So I think Cameron was probably playing more to his domestic audience, sort of, you know, but also referencing perhaps the sort of dilemma the UK has of how far in and how far out of the EU it can be. Got one more question, which I'll take, and then I'll hand back to Robin, the gentleman in the white shirt at the back row.
Hi, this is Ed from Beijing, and I'm running a private business there. And I'm just curious about actually the implications, given the current status in Europe, the dire straits, the economy there. What are the implications for the Chinese companies who are not necessarily looking into, you know, investing there, but rather than a buyer by purchasing goods from, you know, Europe? Does that necessarily mean that actually, you know, the prices are cheaper there, or people are more willing to sell abroad? Just as a Chinese company, I'm very curious in knowing this.
So you're talking about buying as a
That's
Chinese
right.
company
That's
here,
right, yes.
buying Chinese,
from
European goods.
Yeah.
Well, I mean, within Europe, you've got a sort of great diversity of competitiveness, productivity. You know, Portugal, Greece are still actually quite expensive places to buy things from because wages are still too high. Inflation's higher than it should be given how weak the economies are, for example. Whereas German companies probably keep sort of pushing prices down and be sort of honing their competitiveness even more. So it probably depends on which countries you're looking at. And of course there's always Eastern Europe as well, because a lot of companies in Germany are looking at Czech Republic or Poland, taking factories out of Spain, for example, and relocating them in Eastern Europe to sort of keep prices down as well. So it's probably quite a sort of nuanced picture, difficult to say, sort of speak of Europe, a Europe price per se. Well, with that, I thank you again for listening and asking questions, and I'll hand you back to Robin for summing up. Thank you.